Welcome all, and thanks very much for coming. We love putting on these seminars, and we love meeting all of our members. This is our third seminar. We've done one in Sydney and Brisbane and Melbourne today. What I really wanted to talk to about today is building smarter portfolios. We've heard from Bruce that for some of us we can maximise some of our contributions into our SMSF before the 1st of July. And I think the question really is and something that I've been banging on for 15 years now is, where do you put that money? And with the ASX, we had our seminar in Sydney a couple of weeks ago. We did it at the ASX. Reason being is it's free if you let the ASX talk. And so they came and talked to us about the ASX being a supermarket. And I thought that was a great analogy because investing is a bit like a supermarket or a bit like cooking. We think the ASX is a great supermarket. The problem with cooking is we don't all have personal chefs, or we can't afford personal chefs. And when we go to the supermarket, if you're a bit like me, I don't exactly know what to put in the trolley. I don't know what's in my cupboard at home. I don't know how to cook international meals. And usually I have to rely on mum, my wife, friends or families, or the internet to learn how to cook. What we've done over the last few years is build our portfolio manager. It's been a sort of crusade, I guess, of InvestSMART to work out what you've got in the cupboard, what you've got in the portfolio, and how those ingredients react with other ingredients to make your portfolio better. First question is, how many people in this room think they have a diversified portfolio? How many people think diversification is important? So did anybody see the ASX? The ASX did a survey. They do it every 2 years. This came out last week. And on the right-hand side, there's now 11.2 million Australians with investments outside of super. It makes up 60% of the population. And they did this massive study. It's really good. It's really insightful and interesting, and you can download it for free from the ASX website. But basically, 46% of people said, which pretty much you guys were right, about half the room here said they were diversified. But funnily enough, those 46% that said they were diversified only had 2.7 products. The 40% of people that said they weren't diversified, and this is on exchange, so this is exchange-traded products, they held 1.6 investments. 75% of all people surveyed only own Australian shares. And this is why we've been banging on about this for 15 years at InvestSMART. It's why we bought Eureka Report, to give us more of a voice to educate our population and the Australians about diversification. It's why we have Intelligent Investor, which teaches us about diversification within a portfolio. So even when we talk to lots of our members, they go, yep, I own Woolworths, I own BHP, I own Coles, I own whatever, and they've got 3 or 4 stocks. That's not diversification. So it's about diversification across asset classes, and it's about diversification within asset classes. So we built the portfolio manager. The portfolio manager, does anybody here use our portfolio manager? So the portfolio manager allows you to put in, that's getting better by the way, we've got about 60,000 people using this now, tracking about 86,000 portfolios with about $19 billion worth of investments that they hold inside of those portfolios. The portfolio manager allows you to put in all of your assets, whether they're managed funds, shares, houses, whatever else. The cool part about the portfolio manager, which has taken us a long time to develop, is it looks through every one of your investments and says whether it's got exposure to Australian equities, international equities, and draws you a nice little pie chart of what your entire asset allocation is. So for example, you might have, I don't know, an A-REIT or a property sort of stock. It looks like an Australian equity, smells like an Australian equities, but actually it's property. You might have some hybrids. Looks like Australian equities, but in fact it's fixed interest. You might have Sydney airports, and so this is, we bought this in about 6 months ago. You might have Sydney airport, we call that Australian equities as our global rule in the portfolio manager, but you go, I actually think of that as property. We allow you to change the underlying asset mapping for individual stocks and funds and whatever else. And actually what happens is the portfolio manager learns. So if everybody of our members have all said Sydney airports is property, we change our global rule that the next person who comes along, we say it's property, but then that person can change it back to Australian equities. We then compare your asset allocation to what we believe is a good asset, an expert asset allocation for your risk profile. And the risk profile is not your risk profile, it's your risk profile of your fund, of your portfolio. So I have two portfolios. One portfolio might be saving for a house, which may be conservative. Another one might be retirement, and I'm only 40 years old, so I'm actually more of a growth. So we draw the pie chart of what we believe is the right asset allocation, and we compare it to your asset allocation and give you a health check score. I did this last November. This is my health check score. Last year, in November, I was 92%. So it changes. So the problem with investing and, excuse me, and dissimilar to cooking is our ingredients are always changing. So in an investment portfolio, unbeknown to you, but your different asset allocations are going up. Australian equities is going up, international equities is going down. Everything's changing continuously. And that can spoil your portfolio. 6 months later, mine's 89% because Australian equities has gone up. So what this health check does for you is the goal is not to get to 100% necessarily. The goal is to know your exposure. So we've back-tested this. So for example, in 2000, if you went to an advisor and you got given a portfolio of funds and stocks that was balanced, you would have come to this and you would have been probably 100%. Over the next 6 years, if you did nothing to your portfolio, your Australian equities and international equities would have gone up. You probably would have doubled your money. And in 2007, your portfolio would look more like a high growth portfolio than it did a balanced. And your health check score would have deteriorated, and we'd be emailing you. Eureka and Tony would be emailing you going, rebalance, rebalance. You're overweight this, you're overweight that. We're not saying we picked the top of the markets. The fact is you're overweight Australian equities and international equities, and your portfolio now look like a high growth portfolio. So when you lose 50% because the market crashes, it's because you had a high growth portfolio, not because you had a balanced portfolio. If you were following the health check score and your portfolio was deteriorating, and at some time in 2006 or 2007 you decided to rebalance, you would have put money, you would have taken some money off the table in international equities and Australian equities, and you would have put more money into cash and fixed interest. 2009 was the low. 2007, 8, 9, fixed interest was the best performing asset classes. 2009 was the low of the market for Aussie equities. Your health check score would have been deteriorating again because now you're overweight fixed interest in cash, and it would have been asking you to actually put more money into Aussie equities and international equities. It doesn't pick the market. I was trying to explain to somebody in Brisbane last week. All it's doing is saying when you're overweight a particular asset class, but usually that asset class, you're overweight because it's had a great run. And rather than actually going, my luck's going to last forever, we're actually saying, just be aware of your asset allocation and your exposure to the different asset classes. You can also see on the left-hand side, I've matched mine against a growth portfolio. These services are all free. We've built this free 15 years ago. It'll be free forever. It is our crusade to teach people how to diversify. And I want to show you now why diversification matters. One quick thing, and going back to, on the left-hand side is we went and had a look at all of our guys that say, all of our members using our portfolio manager. So we're not doing that well in my crusade, by the way. Members' conservative portfolio on the left-hand side. So there's about 10,000 of them. I've just collected them all together. This is what we think is on the right-hand side. Obviously, we've got more money in fixed interest in cash, and our conservative guys have got oodles of Australian equities and property. Down the bottom, as I said, I did this 6 months ago. Biggest moves in 6 months for our members, 3% out of cash and fixed interest and into Australian equities. Who knows what the best performing asset class in the last year is? Australian equities. It amazes me how much we see our members, and we've got like 700,000 of them, 80,000 in our portfolio manager, continue to chase last year's returns. On the right-hand side, our biggest move, so we continually change our asset allocation that we match you against. We've gone 6 months, for the last 6 months, we've gone 15% out of cash into fixed interest and a small allocation into global infrastructure. Our fixed interest is going into floating rate notes. We think we're at, there's more risk of interest rates going up than going down, and so we're moving our asset allocation to be a little bit more for that hedge against interest rates rising, or to take advantage of interest rates rising. I won't go through our balanced and our high growth. This is our growth. Again, on the left-hand side. Now, these guys' health score is improving because we expect them to have more growth assets. We expect them to have more international equities, Australian equities and property. Again, they're way overweight Australian equity, or way overweight property and a little bit of Australian equities. And again, we're seeing them getting out of cash and fixed interest into Australian equities, and we're going more into floating rate notes and global infrastructure. So why does asset allocation matter? These are the rock stars. So I think we all know intuitively of don't put all your eggs in one basket. It's an age-old adage. These guys in the 50s and 60s did the mathematical work or framework to come up with why it matters, and I'm going to show you how that works. Some of you would know Markowitz. He's pretty much the only person that anybody knows about CAPM and modern portfolio theory. Sharpe, for anybody who's doing their own security valuations, that's the Sharpe ratio. And I've never heard of Miller, but he won a Nobel Peace Prize as well with these three in 1990. And you know, if I was Miller, I'd be upset because no one's ever heard of him. But what I want to show you is in these new slides, and I haven't made this up, this is straight out of our data that we get from Morningstar on every managed fund. The blue is, I'll go for the right first. The orange is the average index return for, on the left-hand side, I've looked at diversified portfolios, conservative, moderate, balanced growth and high growth, and then the asset class specific on the right-hand side. The blue is all the fund managers in Australia that are benchmarked against the same benchmark. Yeah, so the blue is benchmarked, that's all the peers, all the managed funds in Australia that are benchmarked against the Morning Australian multi-sector conservative, and the blue is actually their benchmark. I'm not getting into the active versus passive debate and all that stuff and fees. Well, I'm actually getting into fees. The difference in those two is pretty much fees. And this is the average, remember, and fees, they're always going to underperform their benchmark because the benchmark is just a mathematical equation. It's got no expenses or costs to actually get into that fund, whereas all fund managers, and even us, we have some fees to actually give you exposure to those sectors. As I said, the best performing asset class is Australian equities. So what happens at 2 years? Best performing asset class is property. What you're not noticing is on the left-hand side, the diversified portfolios are coming up. 5 years, international. So we've got a different asset class in every time period. And every single time period, no matter which one I choose, on average, the fund managers benchmarked against a similar benchmark underperform their benchmark. This is 10 years. Fixed interest is the best over 10 years. And look at all the diversified portfolios. This is the guts of why diversification matters. And if I go back to what Markowitz and those guys said is, they basically said you can add an asset to a diversified portfolio that's not correlated to other assets within your portfolio and maximise return, or you don't actually risk any returns. And that's what these guys proved. And I just had a look at all the different managed funds. I did this in April. Of all the fund managers in Australia, their returns, the benchmark returns, and that's what I found. And I think if I did it even longer term, 20 years or 50 years, it would show you that the diversified portfolios will outperform all the asset classes or be at least as good as the asset classes over that period of time. And so, yes, you could have stayed in fixed interest, but now you'll actually be suffering. You could have stayed in Australian equities and you'd probably make some returns. But if you're diversified, you wouldn't have gone through all those highs and lows over the last 10 years or 20 years. So as I was saying, I wasn't saying. So what we say is we then developed a number of portfolios or investments using ETFs. So we bucketed together a portfolio of ETFs to help our members plug their gaps. So what we're talking about is how do we help our members diversify? So we give them free tools to let them see where their exposure is. Whether you want to add, you might already have a diversified portfolio. You might use our health check score to see where you're underexposed or where you're overexposed. If you're putting in more money into your SMSF before 1st of July, maybe don't put it into Australian equities if you've already got loads of Australian equities, maybe put into something different to diversify your portfolio. We created portfolios as well for our customers. On the left-hand side, we've got our growth diversified portfolio. Obviously, if you just invested in that growth portfolio and put all those assets into our portfolio manager, you'd be 100% because it's matched one-on-one. We also created our diversified income portfolio for those people who are looking for a bit more income rather than just for growth. And on the right-hand side, because we know a lot of our members have existing portfolios, we're not saying sell what you've already got. We're saying just have a look to where you're underexposed, and we created a number of portfolios of ETFs to give people exposure to the asset class specific assets. On the right-hand side, we do this for 77 basis points. On the left-hand, the ETF portfolios, so the two core portfolios, and the fixed interest, property and international are 77 basis points. And the two direct equities, which is the intelligent investor portfolios, which is about 20 stocks of direct Australian equities, they're 97 basis points. These are all under an SMA structure. So as Max was talking about before, when you see these investments, think about it as if you remember in the old days, you used to have a broker and you could sign a limited power of attorney to manage a portfolio of securities on your behalf. It's like that. We manage a basket of securities on your behalf. If you think we're rubbish at doing that over time, you can either cut out of this and we give you your cash back, or you can take all of those individual stocks or securities over into your own broking account, and we can transfer it in specie over to your broking account. There is no tax consequences from that. From day dot, when you buy these SMAs, you have the beneficial ownership of the underlying securities in that portfolio. So I should show you how they've also gone. The InvestSMART's in the blue, the peers are in the orange, benchmark, and the fees. Why I wanted to talk about fees and why I showed you those in the other ones, and there's only 3 slides. I know we want to get back to the Max and Bruce show with Q&A. Why I wanted to show you this is what we manage as managers is we manage not the individual stocks, apart from the II portfolios, we manage the asset allocation. So we have an active management of asset allocation. We have a passive management of the exposure. So we buy an ETF or we buy index tracking type funds to match the exposure we want in the asset allocation. We're doing quite well at that at the moment, but I honestly believe if we came back in 10 years or 20 years and showed you these slides, it would show InvestSMART under the benchmark by 77 basis points, and would show our peers under us by the differential in the average fees. The only thing that happens over time is the difference in fees, and we can have many discussions afterwards of me can prove that as well. Diversified income portfolio, again, we're doing quite well in our asset allocation mix. I think long term we'll underperform our benchmark by our fees, and we'll outperform the average of our peers by the differential in fees. Don't get me wrong, that's the average of our peers. There are fund managers out there that'll beat us. We're not out there to actually try to beat people and pick individual stocks and have a high conviction fund. We're just trying to be middle to the high end and just outperform them on fees. It's not about individual security selection. It's about asset allocation. And this is our intelligent investor equity income portfolio. Again, there's 10 analysts in our team who pick individual stocks. But unlike some of you in this room, and definitely a lot of the people in the ASX study, we have a portfolio of about 20 stocks. So, for example, what I did, and just a closing comment, what I did on my portfolio about 3 years ago, I used our health check thing. I had a rubbish health check score. I had about 3 or 4 penny dreadful stocks. I had a couple of managed funds. I used our health check score. I said it was rubbish. So I bought some intelligent investor. I bought this one. I invested about 50 grand. I put 100 grand also into our growth portfolio. So I got better diversification in my Aussie equities, and I got broader asset allocation across the other asset classes through the InvestSMART growth portfolio. and I got my health check score up to about 86, 87. Thank you.